Hi, my name is Emma Heiss, and in this video, I'm going to be discussing the current state of the United States economy. Okay, so the way I'll be doing this is by breaking down and explaining 4 different topics that all impact the economy. The first topic I'm going to be discussing is the unemployment rate of the United States. Then I'm going to be talking about the current GDP. After that, I'll be discussing the inflation rate. And finally, I'll be talking about the current account situation for the United States. Okay, so unemployment rate and changes. As of September 2024, the current total unemployment rate for both men and women in the United States is 4.1%. This rate is slightly better than the one that was recorded in August of 2024, which was 4.2%. And you can reference both of these statistics in the graph to the right. So a few circumstances that led to this rate include the addition of 254,000 new jobs to the economy in September. Although roughly 15,000 jobs were lost or estimated to be lost, this is still a significant improvement. Another circumstance is the increase in price for goods. The number of people still spending money is high, and the government has slightly lowered interest rates, which also makes it easier to hire more people, especially for bigger businesses and corporations. So while the employment rate isn't a historical low for the United States, it is still considered relatively low. It's also a significant improvement overall from April of 2020, when the employment rate was at a high of 13% due to the pandemic. So GDP and economic data. The current GDP in the United States is 3%, and we're currently in quarter 3. This is a significant improvement from quarter 2's 1.6%, which is a little more than double what it was before. The economy is currently in a recession because the GDP is increasing and because the job market is so strong. This is because if interest rates aren't high, then that means that businesses can hire more people. They can also start investing more, and it gives people who are just actively seeking jobs more opportunities. So having a GDP that's at 3% is considered relatively healthy because it means that the job creation and consumer spending are both increasing. It also means that the economy isn't at a high risk or vulnerable position to crash like it was in, say, COVID. Inflation rate overview. So the current inflation rate in the economy is 2.5%, and that's been recorded over the past 12 months. The rate did increase slightly from the last month by 0.2%, but it's still a reasonable rate. While having an inflation rate of 2.5% is slightly higher than the desired 2%, it is still considered a fair rate. Consumer spending has been both high and steady recently, which is especially positive for businesses because it means that they can continue hiring new employees and even expand their brands if they really wanted to. Since 2.5% is slightly higher than the previous month, something the central bank or government could do to step in is to slightly raise interest amounts or rates. This would help to slow down the amount of spending and borrowing money that people would do or businesses that they would typically do. They could also provide loans to small businesses to help them just maintain a steady revenue. Current account impact. So the United States has a current account deficit of negative $266.8 billion. Although this isn't a record low for the country, having a high deficit such as that one means that the United States is importing more goods and services than they are exporting. And while importing goods and services is a good thing, having a high deficit means that a lot of jobs and other opportunities for Americans are lost. It also means that the United States is more vulnerable to economic shifts like the pandemic, since a large portion of their exports are coming from different markets and countries. And on the right, you can just reference another chart or graph right there. So to conclude this video, I just wanted to touch base on the 4 primary topics that were covered a little bit earlier. So the unemployment rate, again, it dropped from 4.2 to 4.1%, not huge of a difference, but it still shows that there is a positive and normal rate there. The GDP also rose from 1.6 to 3%, which shows steady growth in the economy, which is a really good thing. The inflation rate is 2.5%, which has been better than previous years. And the United States has over $2 billion in an account deficit, but it definitely has a lot of room to improve, and overall the economy is flourishing. And then lastly, I just have my citations.